Welcome to the deep dive. We take stacks of information, financial reports, presentations, conference calls, and boil it all down to what really matters. Today, we're diving into APL Apollo Tubes. They're India's top branded structural steel tube company. We've got their Q1 FY26 results, their strategy presentation, and some interesting bits from their latest conference call. So our mission today is really to unpack all this for you. We want to help you understand the key takeaways, how they performed, what their big picture plan is. Get ready for, well, hopefully some useful highlights. Okay, so let's jump right into the Q1 FY26 numbers first. APL Apollo reported sales volume 794,000 tons. That's up 10% year over year, which sounds pretty solid. Revenue also up 4% year over year, Rs 51.7 billion. EBITDA, a strong 23% jump year over year to Rs 3.7 billion, and net profit mirrored that, up 23% year over year too, at Rs 2.4 billion. EBITDA per ton landed at Rs 4,683. So yeah, the year-over-year picture looks quite healthy. But then you look at the quarter-on-quarter figures compared to Q4 FY25, and there's a bit of a dip.
Sales volume down 7%, revenue down 6%, EBITDA down 10%, and net profit down 19%. That's quite a different story, quarter on quarter. What's the narrative behind these sort of mixed signals?
Yeah, it's a great question. And look, the management, they were quite open about it. They said Q1 performance was actually below their own expectations. They were aiming for maybe 5% higher on the sales volume side.
Okay.
And they pointed to several sort of external things happening. First, just a continued slowdown in the macro environment, right? You saw weaker industrial production data, GDP growth expectations for Q1 were a bit softer. Second, geopolitical tensions definitely played a part. There was that India-Pakistan border issue, which hit volumes in the northern states for like a week.
Right.
And then the ongoing war in the Middle East, that apparently affected export volumes coming out of India towards the end of July.
Okay.
Plus, you had the monsoon arriving early in June, which always slows down construction activity. And one more thing, a softer money supply. That apparently reduced the buying power for their dealers and stockists. So yeah, quite a few headwinds hitting them all at once.
Yeah, I could definitely see how all those factors would create a pretty challenging quarter. And digging into the financials a bit more, I saw something interesting about an impact on their A spreads, this notional ESOP expense. Could you maybe break that down a bit? Because that seems like a key detail for understanding the real profitability picture. And just for everyone listening, A spreads, that's basically their operating profit per ton of steel sold. It's a really key metric for them.
Absolutely. Yeah, that ESOP expense. So it was a one-time cost, about R6 crore. And the key word here is notional.
Right.
It means it's an accounting thing related to stock options that vested from grants made like a year and a half back. It's not an actual cash outflow impacting their operations day to day in the quarter.
Got it. So not cash leaving the building.
Exactly. And the company was very clear, this specific charge, it's not expected to happen again from their new ESOP plan 2025, at least not in the next 12 to 24 months. Going forward, they think their normal quarterly employee costs should settle around Rs 87 to 88 crore, which, worked out to about Rs 600, 700 per ton in their metrics. So yeah, that Rs 100 per ton hit you saw in Q1 definitely seems like a one-off event.
Okay, that clears that up nicely. Thanks. So moving beyond just the quarter's numbers, the company's been talking quite a bit about this brand premium strategy since, January 2025? Feels like a pretty fundamental shift. How's that actually playing out? With their product mix, their profitability, what does it tell us about where they're trying to position themselves long term?
Yeah, it's a really key part of their story now. The strategy, it's essentially about prioritizing profit margins, those A spreads, over just chasing sales volume no matter the cost. It's a deliberate move to sort of decommoditize what they sell, make their products less like basic commodities.
Yes.
And you can see it working in the numbers. In Q1 FY26, their value-added sales mix, the more profitable stuff, actually increased to 61%. That's up from 58% in the previous quarter, Q4 FY25.
Okay, so progress there.
Definitely. And you see the payoff in the profitability of these specific products, like Apollo Structural Heavy that generated Rs 8,382 per ton in EBITDA. Huge margin. Apollo Z Rustproof was at Rs 5,437 per ton, and their coated products at Rs 5,971 per ton.
Wow, those are strong numbers.
They really are. And this 61% value-added mix, it's not just a statistic. It shows they're gaining real market power. I mean, think about it. They're successfully selling at a premium, even in the general product category where they said competitors are selling like Rs 3,000 per ton cheaper.
Yeah.
APL Apollo still managed an A spread of around Rs 2,741 per ton on those general products. That shows they're setting the price, not just following it.
Right. They're resisting that race to the bottom.
Exactly. They're establishing themselves as the premium choice. And their goal now, for their India-based general structures business, is to push the profitability above Rs 3,000 per ton. That's excluding their Dubai operation, by the way.
Okay, so they're definitely succeeding in differentiating themselves and getting that premium. That's crucial. And it's not just about, tweaking the existing product mix. They're also planning a massive expansion in capacity. That signals some serious long-term confidence.
Oh, absolutely. The expansion plans are quite ambitious. They're looking to grow capacity from 4.5 million tons, where they ended FY25, all the way up to 6.8 million tons by FY28.
That's a big jump.
It is. And it comes with a significant investment, Rs 15 billion in capex over the next 3 years. This includes completely new greenfield plants, one in eastern India, actually 2 Gorakhpur and Kolkata, one in the west at Bhuj, and one down south at Numalur. Plus, they're doing some brownfield expansions at existing sites. And they're also adding 200,000 tons of capacity in Dubai. And crucially, adding new product lines, too, like 500,000 tons of new coated capacity, 100,000 tons of those heavy structural tubes, and other special tubes.
Yeah, that heavy structural tube expansion, that reminds me of their big innovation with that 1,000 by 1,000 millimeter diameter pipe. Weren't they the first in India and only the second globally to make something that big? How does that kind of innovation link up with this expansion?
Precisely. That heavy structural tube capability and other large diameter pipes they're developing, they fit perfectly with some really booming sectors right now. Think data centers, massive warehouses, new factory construction happening all over India. These are areas seeing huge growth.
Right, the infrastructure build-out.
Exactly. And the company actually expects something like 20-25% volume growth just from these emerging segments alone over the next 3-4 years. So it's a really strategic bet on these high-growth, high-value applications.
Okay, a very clear strategic direction there. Now, thinking about their wider impact, their long-term vision, what does all this mean for their ESG efforts? Environmental, social, governance. How seriously are they taking that?
They seem to be taking it very seriously, actually. Their commitment looks pretty strong across the board. For instance, they scored in the 89th percentile in the 2024 DJSI, that's the Dow Jones Sustainability Index, which is, quite a high score globally.
That's significant recognition.
It is. And maybe even more importantly, they got validation from SBTI, that's the Science-Based Targets Initiative, back in February 2025. They've committed to net zero by 2050 and a 25% cut in their scope 1 and 2 emissions by 2030. Those are concrete targets.
All right.
On the energy front, they already get 72% of their power from renewable sources, and they're aiming for 80-85% within the next 2-3 years. Pretty impressive.
Yeah, that's high.
And then there's this really innovative concept they call steel for green. This isn't just talk, it seems quite pioneering. They've actually developed ready-made steel products like door frames, handrails, specifically designed to replace wood in construction.
Oh, interesting.
Yeah, and they estimate this is saving something like 250,000 trees every year. Plus, they make the point that using structural steel in buildings can cut carbon emissions by up to 60% compared to traditional reinforced concrete, mostly because steel is highly recyclable and structurally more efficient.
That's a really powerful argument for steel and sustainable building.
It really is. It could genuinely shift how we think about construction materials if it catches on more widely.
Absolutely. That's a tangible environmental benefit. And speaking of strengthening things for the long term, I did notice they made some changes, some additions to their board of directors recently as well.
Yes, that's right. An important governance point. They've brought in some really seasoned people. Chakram Kumar Singh is now director and COO. And they've added 2 new independent directors, Dukhabandhu Rath and Rakesh Sharma. Both Mr. Rath and Mr. Sharma have really extensive backgrounds in banking and finance.
Okay.
So that definitely adds more financial expertise and strong oversight to the board, especially, as they're navigating this big growth phase and CapEx program.
Right. Makes sense to bolster the board. So with all these strategies, the expansion plans, what's the outlook then, especially for the second half of FY26, given, that slower start we talked about? Are they feeling confident? And did they mention anything about managing risks? Like what if those geopolitical tensions flare up again or the monsoon drags on.
Yeah, despite the Q1 dip, management sounds remarkably confident about the second half of the year. Their baseline expectation is that, well, the monsoon season will end and construction activity will naturally pick back up. That's a big driver for them. Then there's government spending. It's still strong, particularly on big infrastructure projects like railways, aviation. That's expected to keep going, maybe even accelerate. And private infrastructure is also looking positive. The warehousing, the new factories, those data centers we mentioned, that demand seems robust.
Okay.
Even the retail side, which is actually 50–60% of their sales, mostly for individual homes, they expect that to pick up as hopefully inflation cools down and maybe interest rates ease a bit.
Right.
Now, did they detail specific contingency plans for every single what if? Not explicitly in what we saw. But their confidence seems rooted in the strength of these underlying demand trends, and also maybe their ability to lean more into those higher value products if the general market gets choppy. Despite the challenges in H1, they actually reiterated or slightly revised their full-year volume growth guidance to a pretty strong 10–15%.
Okay, so they're sticking to a positive outlook. Now, APL Apollo, they always seem to emphasize financial discipline.
Yeah.
With these big expansion plans needing funding, how are they approaching capital management debt?
Yeah.
Especially since they seem to be holding net cash. What's the philosophy there?
Yeah, they are very disciplined financially. It's a key part of their identity. They managed to keep a net cash position of Rs 2.1 billion at the end of Q1 FY26.
Impressive.
It is. And their net working capital days are incredibly low, just 6 days. That's very efficient. What's really insightful, though, is how they explain their capital allocation strategy. They call it the 4-bucket approach.
Oh, yeah. How does that work?
Well, basically, for every Rs 100 of operating cash flow they generate, Rs 25 goes to pay taxes. Okay, standard enough. Another Rs 25 is earmarked specifically for CapEx, funding that growth we talked about.
Right.
Then Rs 25 is allocated for shareholder rewards, so dividends or maybe share buybacks.
Okay, returning value.
Exactly. And the final Rs 25, they keep that as a buffer to strengthen the balance sheet, maybe pay down any liabilities faster, or even use it to get discounts from suppliers by paying cash up front.
Ah, clever. A built-in cushion and opportunity fund.
Precisely. It's a very systematic way to manage their cash. And it all feeds into their focus on maximizing ROCE, return on capital employed, which was a healthy 28.6% in Q1 FY26. It really underlines that disciplined financial approach.
That's a very clear framework. So putting it all together, the financial discipline, the focus on value-added products, the premium strategy, where does that leave their guidance for the overall A spreads for this year and maybe longer term?
Right. So for this full financial year, FY26, they're guiding for A spreads to be somewhere between Rs 4,600 and Rs 5,000 per ton.
Okay, so a clear step up.
A significant step up, yeah. Remember, FY25 was below Rs 4,000 per ton. So that guidance really shows the impact they expect from the premiumization strategy kicking in. And then long term, as they build out towards that 7 million ton capacity mark, their ultimate ambition, their goal, is to get A spreads consistently into the Rs 5,500 to Rs 6,000 per ton range.
Okay, ambitious, but seems grounded in their strategy. So wrapping this up then, what are the key takeaways for you, the listener?
Well, I think we've seen a company here, APL Apollo, that's navigating some pretty choppy macroeconomic waters with quite impressive resilience. They've got a very clear strategy focused on higher value products, on sustainable growth. They're not just, reacting to numbers quarter by quarter. They seem to be actively executing a long-term plan for market leadership, for operational excellence, and all while keeping a really tight grip on their finances and making serious ESG commitments. It's quite a compelling picture, really, of adaptation and ambition in a fundamental industry like steel. That sums it up well. And maybe just one final thought to leave people with. Consider the impact, the profound impact that our choices about materials have on the planet. How might the steel industry's push towards sustainability, which we see happening here with initiatives like Steel for Green, how might that genuinely reshape our whole approach to building things, to managing resources over the next decade? Could steel actually become a primary material for genuinely green construction? Something to think about.